I gave a talk and helped over 1,200 entrepreneurs and real estate investors get access to business credit. So if you give me the next 9 minutes, I'm going to share with you exactly what I shared with them that's going to help 12x your ability to get access to business credit. So with that in mind, I'm starting the timer. Let's get right into it. So at the top, you are treating your personal credit like it doesn't matter. You see, a lot of people, especially when they're starting out, they think that they can just neglect their personal credit. Here's the psychology behind it. They say, wait a minute, if I'm just going to use my business credit, my LLC, and I'm going to build business credit through my EIN, then me needing to have good credit doesn't matter. But that's a misnomer. Here's why. If your business is generating under 4.5, really in this economy, under $5 million a year over the last 2 years or 24 months consecutively, then the odds of you having to personally guarantee is going to be 99.99999% of the time. So the fact that you think that you can just neglect your personal credit, run it to the ground, have less than a 600, gosh, even less than a 650, again, in this current lending economy is going to serve you far less than if you had strong personal credit. The reason for that is because your business isn't in a position, especially if you're generating under that $5 million threshold, or if you don't have any business credit at all, whether it's business credit cards or business lines of credit, you're not able to get, or your business isn't in a place where it can get access to business credit on its own. So you essentially have to co-sign on behalf of your business so that it can get the capital that it needs, similarly to how a parent would go in with the child or with the loved one, whether they're trying to purchase a property or they're trying to purchase a vehicle. They'll have to co-sign the person with the better credit on behalf of the other person. It's the same thing. So in this case, your baby that you're co-signing for is going to be your business. Number two, ownership percentage can make or break access to capital at scale, especially when we start to venture in with a lot of our clients. They start to venture into the world of business lines of credit. Typically, if you're just getting access to a business credit card, you're just going to have one of the applicants on there. And so if you have a 50-50 split on the LLC, you have some type of partnership, or you have an S corp and you have maybe multi-members on there, then what ends up happening is if it's 50% ownership, or if it's 40-60, so it's 60% you, 40% the person that you're working with, so in this case, your business partner, both of you will have to be on that business line application. Now, the reason why this is important at scale is because if you have borrower A, so business owner A, and then borrower B, which is business owner B, one person maybe has too many derogatories on their personal credit. Remember what I just finished saying about you having challenged credit. That comes back out to play later on as you try to scale capital, especially with the bigger capital, not the baby business credit cards that most people talking about. I'm talking about the big business lines of credit that you eventually want to get into, especially if you're doing things like covering payroll or if you're getting into real estate ventures. The other thing when it comes to you using multiple members on the business credit line application to scale your capital is if you have someone that's previously attached to another entity, then what ends up happening is all the baggage that they had from maybe the credit exposure, meaning how much capital they were able to get access to and they were personally guaranteed for another business, also comes out to play later on as you scale. So this is a conversation that you want to have if, and again, something that we do with our clients, if you have multiple members and we want to see who's actually going to be the primary when we're looking to scale the capital and who's going to take the back seat. Number three is you're applying for too much too quickly. This comes and no surprise, because there's a lot of fluff out on YouTube about credit stacking, and you can just blindly apply for a bunch of stuff and you're going to get approved. Look, you're shooting yourself in the foot. Here's why. Banks and algorithms are getting a lot smarter. And so even if you just submit an application and you think that, hey, I can have multiple windows open and in real time just submit these other applications, they're seeing in real time within milliseconds how many applications you're submitting. And so the whole thought of, if I just apply for these 5 things on the same day, then the likelihood of me getting approved for something, those days are gone, at least the way that we're seeing it. Now, again, can you get away with baby business credit cards every now and again? Yes. But if you're watching this channel, you know we talk a lot about business lines of credit, and you know we talk a lot about real cash value stuff. None of this business credit stacking that you tend to see where you're just applying for a bunch of different things randomly, hoping that it doesn't hit your credit report, and then you're going back in to see what hit and what didn't hit. And so you actually want to be strategic about what applications you're submitting at any given moment, and then the sequence that you're going about it. And so are you going to put bank A above bank B? Are you going to put yourself to maybe connect with credit unions first before going in to talk to big business banks? Or are you going to put big business banks at the top and then put credit unions all at the bottom, which is something that we help our clients strategize all the time? Number 4 is your business name is holding you back. Congruency is big in business credit. And so if you have a business that's ABC Construction, but then you're going in there and you're asking for capital and you're positioning yourself like you are a consultant, you're shooting yourself in the foot. I'd rather see someone, and again, I have this talk all the time with business owners. Hey, if you're in construction, we can still keep that line of work. We don't automatically have to reposition you out of there. We just have to position your business by taking a look at the 4 levers that we look at during our process. We have to take a look at how your business is actually structured, and we can still keep you within that same name or that category. We don't automatically have to shift you over into a consulting, especially if that's not what your business actually does to generate revenue. And speaking of revenue, number 5, what do you actually do to generate revenue? Is it a subscription model? Is it cash clients? Is it, do you have them on some type of merchant setup where it's maybe an agency? Is it just a one-time payment? The reason this is going to be important is because when you sit with business bankers, they're going to ask you and they're going to field you a couple different questions. And they're going to say, what do you actually do to generate revenue? We know here that you put on the application, you generate right around $250,000 a month, but what is the actual model that you're running to generate this revenue? Especially when we start to venture into the land of SBA funding. This is important because banks have this protocol called KYC, which is know your customer. And so when they're doing their due diligence on you, you should walk in there having done due diligence on your own business. Sidebar, apart from you actually knowing how you generate revenue, forget just getting access to the business capital, because that's going to be a byproduct. This is going to make you a better business owner as a whole. Number 6, don't neglect your industry classification, because remember what I just said about congruency. This is going to tie in to how your business is actually structured. And so if you are in construction or real estate, don't just put on there that you're in consulting just because you saw a video on it, because we're seeing this get flagged in real time. They're going to go back to that protocol, which is know your customer. And they're going to say, based on all the metrics that we have for how you're driving revenue to the business, what does fix and flips and what does construction actually have to do with you consulting, right? Can you work in the gray area? Possibly, right? But in my opinion, and just based off the data that we've seen across all different industries, we've just seen that people that are categorized properly within the subcategories of their industry. So you're in construction, but your subcategory is roofing, and then the category under that is residential roofing or construction or commercial roofing. You're able to use that and scale your capital a lot further than just having to try to find these little loopholes here and again. Number 7, opening up bank accounts alone isn't going to create a positive history. You actually want to open accounts, have cash flow running through it, and you also want to use those accounts, whether you're using it to cover payroll or if you have some type of business credit card or even a personal credit line that you've opened up with that bank. Number 8, pay attention to the lending appetite. This means that you can have the right industry, perfect credit, but if that bank doesn't want to actually work with your industry, then you'll have to either reposition the way the business is classified, which we do with our clients all the time, or take a look at another bank as a whole. Number 9, business credit ratings matter much more, or as much, if not more, than business credit scores. Business credit ratings is the history that your business has been in existence, how your business actually generates revenue, what type of credit your business actually has. So that's the whole holistic picture of your business credit report. While the business credit score, it's just a number. So just looking at your paycheck score, really what that means is that you just been making your payments on time. You want to have both working cohesively on behalf of your business. And number 10, plan your funding strategy before you actually need the capital. I tell my clients this all the time. I'd rather have the capital and not need it than need the capital and not have it. And so if you don't actually have a plan in place to help you get access to capital predictably and sustainably, these are things that you want to start working into play right now before you actually submit an application or step into a bank. And with that in mind, this is 9 minutes and 19 seconds. So there you have it. If you are a business owner and you don't have these systems dialed in that allows you to get access to capital in a predictable and sustainable way, we can connect with you. Let's take a deep dive into your business, see where you're at and where you're looking to go, and see if we can help. You can book a call. It's pinned as the first comment. InsightInnerCircle.com. We'll deep dive into your business. We'll let you know flat out whether we can help you out or not, and see what systems we can put into place with you that allows you to get access to the capital that you need. But other than that, I will see you guys in the next video. Bye.